everyone. My today's topic is banking architecture of India and credit facilities. Mm, Sir, can I go to next slides? So my name is Atharva Chavan, and I will start the presentation. So banking architecture in India. Uh, my topic con my topic connects basic concepts of banking architecture of India, RBI as a regulator, functions and roles of RBI, role of bank as important aids to trade, functions of banks, and overview Indian banking system, banking structure in India. So basically, what is a bank? Banks are a financial institutions licensed to accept deposits and provide loans. Banks also facilitate financial transaction and economic stability by giving credits, taking deposits, and providing loans. Few examples of banks are commercial banks, cooperative banks, and central banks. Model of banking. There are mainly three types of banks: investment banks, commercial banks, and universal banks. Investment banks are the banks which are intermediaries between security issuers and investors to help firms raise capital. They provide various financial services like M&A, leverage finance, and restructuring risk management. They also provide underwriting, securities trading, asset management, etc. Their main source of income is commissions and fees. Then there are commercial banks which take deposits, make loans, and asset transformation. Their clienteles are private, corporate, and governments. Commercial banks provide services like credit cards, payments, and settlements. Private banking, custodial services, providing guarantees and trade financing. Their main income sources are interest from loans and investment commissions and fees from other services. Universal banks are the combination of investment banks and commercial banks. Their objective is to reap economics of scale in access to technology and capital. So universal banks are basically the mix of investment banks and commercial banks, which balances the access of technology and capital. There are examples of commercial bank in oriented universal banks, which are Bank of America and HSBC, etc. Investment banking oriented universal banks are Barclays, UBS, Deutsche Banks, etc. Following is the list of banks at the end of March 2024. There are currently 12 public sector banks, 21 private sector banks, 44 foreign banks, 11 small finance banks, 6 payments banks, 43 regional rural banks, and 2 local area banks in India. Key functions of a bank: accepting deposits. Banks accept deposits in the form of savings, current, and fixed deposits. They also grant loans like personal loans, business loans, and mortgages. Personal loans are for the uses of persons. Business loans are for the purpose of businesses, and mortgages are the loans taken on the taken for buying home or any car, etc. Facilitating payments, issuing checks, debit or credit cards, online transfer. These are also the functions of bank. Wealth management. Some banks manages wealth also, like investment advisory and portfolio management. Banks like SBI or any bank which is given permission by RBI to exchange currency can also be in the key function of a bank. Types of banks: commercial banks, investment banks, central banks, cooperative banks, and development banks. Commercial banks focus on deposits and loans for individual and businesses. Investment banks specialize in capital raising, MCA, and securities trading. Central banks like RBI regulate monetary policy and oversee financial institutions. Cooperative banks are the banks owned by members and cater to local needs. Development banks finance infrastructure and development projects in rural areas. Banking products and services. Uh, Banks provides some products and services like deposit products. Deposit products are the products which are used for depositing money in the bank, like savings accounts, current account, and recurring deposits, fixed deposits. Bank also provide credit products to get loan from the banks, like credit cards, loans, overdrafts, etc. Investment products of banks are mutual funds, bonds, etc. And banks also provide services like lockers, insurance, and digital banking. Role of banks in the economy. Banks perform a role like mobilizing savings, channeling savings into productive investments, providing credit, enabling business expansion and consumer spending, economic stability, regulating money supply and interest rates, employment generation, direct and indirect job creation, digital banking revolution. Banks also use digital payments, then mobile apps to provide their services nowadays. Services like uh, services like accepting loans, creating KYCs, all through online mode. The digital banking revolution contains online banking, mobile apps, then UPI and NFT RTGS. Convenience, these are convenient, cost effective, and they have enhanced security. There are less, the disadvantages are cybersecurity threats and digital literacy. Current trends in banking. Current banking trends are followed by fintech collaboration, like technological addition to financial institutions, then blockchain technology, sustainability, and green banking, uh, which uh, which has which helps in banks to get more money and less crowd in the system, and open banking ecosystems. RBI as a regulator. RBI was set up on 1st April 1935 under the RBI Act on the basis of recommendations of the Hilton-Young Commission. It is the apex monetary authority in India. Their ownership is fully to the government of India since nationalization in 1947. Their headquarters in Mumbai. Objectives of RBI. The main objectives of RBI are maintaining financial stability, controlling inflation, and ensuring price stability, promoting economic growth, and managing currency and credit systems in India. The board of directors of RBI contains governor, deputy governors, then executive directors, principal general managers, deputy general managers, assistant general managers, then assistant managers, and support staff. The current governor of the RBI is Mr. Shri Sanjay Malhotra. Key functions of RBI: monetary policy implementation, regulation and supervision of banks, issuer of currency, development role, foreign exchange management, banker of the government, and bankers bank. So, monetary policy implementation. RBI uses tools like repo rate, reverse repo rate, CRR, SLR, open market operations to implement their monetary policies. Their main objective is to control inflation, then manage liquidity and stabilize the currency. Example, policy rate adjustments to tackle COVID-19 economic impacts. Then regulation and supervision of banks. RBI provide license to new banks, ensure their compliance with Basel norms, then monitor non-performing assets, risk management guidelines, etc. Implementation of the Insolvency and Bankruptcy Code to address NPH is the example of regulation and supervision of banks. RBI is also the issuer of currency in India. RBI is the sole authority for issuing currency notes in India. They ensures that adequate supply and quality of currency. They manages counterfeit threats. Example, introduction of new currency notes post 2016 demonetization. This was to ensure that there is a limited supply of counterfeit cash. Developmental role of RBI, promoting financial inclusion. The PM Jan Dhan Yojana is the Yojana for financial inclusion, and it promotes the financial inclusion in rural areas, supporting small and medium enterprises, encouraging innovations in digital payments. These are the developmental roles derived by RBI. Foreign exchange management. RBI manages forex reserves, facilitates external trades and payments, ensures exchange rate stability. RBI is also a banker to the government. RBI manages government's accounts, then their debts, facilitates borrowing programs through auctions, advise on financial policies. RBI is also known as Bankers Bank due to the sole reason that it provides credits to other banks also. Acts as a lender of last resort, provides liquidity supports to banks, maintains accounts of scheduled banks. Role during crisis. RBI's role during crisis is to measure to stabilize the economy. In the RBI ensures that the economy stays stable during any crisis, like the 2019's global pandemic. Example are COVID-19 measures like moratorium on loans, liquidity infusions, and rate cuts, safeguarding financial institutions and protecting consumer interests. RBI's role in promoting innovation, sandboxes for fintech innovations, encouraging digital banking and payments. These are some examples of RBI promoting innovation. This is the RBI's official website front page, which states that safe digital banking starts with you. Transact safely. RBI's main motto is RBI कहता है जानकार बनिए सतर्क रहिए. Following are the challenges faced by RBI, which are balancing growth and inflation, managing global financial volatility, tackling rising non-performing assets, and ensuring financial inclusion in rural areas. RBI faced challenges to balance growth and inflation, like when there are growing sectors, the inflation may decrease, but in less growth development sectors, the inflation may rise. Credit facilities, types of credit facilities, secured. There are four types of credit facilities: secured credit facilities, unsecured credit facilities, fund-based credit facilities, and non-fund-based credit facilities. Securities and modes of charges: mortgage, lien, pledge, and hypothecation. Credit facilities: a financial financial arrangement that allows individuals or businesses to borrow funds or use financial instruments provided by banks and financial institutions. This helps in capital formation, business expansion, and liquidity management. So first are the secured credit facilities. These are loans or credits backed by any collateral. Collateral means any security that is pledged pledged to the creditor to get a secured to get a loan. Assets like property, gold, fixed deposits, etc., are the examples of collaterals. So example of secured credit facilities are home loan. A borrower takes a housing loan from a creditor by pledging the purchased house as a collateral. Then there are car loans. The person purchases a car and use it as a collateral for the to the credit facilitator. Then loan against property. A business owner mortgages his commercial property with banks to get funds for expansion. Gold loan. Any person any person pledges the gold that he has to to take a short-term loan for their expenses. These are secure credit facilities. The advantages of secured credit facilities are they get lower interest rate due to the higher security and reduced risk. There are higher borrowing limits for the secured credit facilities. Disadvantages are risk of asset loss in case of default or longer processing time. These are some news for the secure credit facilities. The growth in personal loans has increased 14% growth. Cards like gold major factors themselves. These are some data on the increasing personal loans and their outstanding credit balances. This data shows a composition of credit portfolio. On the y-axis, there are percentage. On the x-axis, there are the years in which the credits has been taken. This data shows that annual growth of loans in India from financial 2019 to 2023 by financial institutions. There is 10.6% growth in year 2019 of banks, and there is 14.3% of growth in NBFCs. This growth declines to 6.3 for banks and 7.6 for NBFCs. Again, this declines, and then the growth of banks is started to see increasing. Financial liabilities of households have risen in the post-pandemic period, as reflected in the surge in retail loan for financing both consumption and investment. Alongside agricultural and business loans have also grown. Notably, more than two-thirds of borrowers are prime and above credit quality. This data shows a composition of borrowings by various sectors. Unsecured credit facilities. Credit provided without any collateral security relies on the borrower's credit worthiness. Creditworthiness of any borrower is decided by their capacity of returning the borrowings. They are given by CRISIL and ICRA. Generally, score of 700 plus is a good score for to take loan. Examples of unsecured loans are personal loan, credit card, education loan. Advantages of unsecured credit facilities. No collateral required and they are quick to processing. Disadvantages. Unsecured credit facilities have higher interest rates, lower borrowing limits, and strict credit worthiness assessment. Fund-based credit facilities. Direct financial assistance where funds are physically transferred to the borrower. Examples, term loans. Uh, Term loans are a type of loan where any company take loan from any bank to build a manufacturing plant, or etc. These loans are generally in high have high amounts. Then working capital loan, cash credit, overdraft facility, export finance. These are some examples of fund-based credit facilities. Advantages of fund-based credit facilities: immediate access to funds, then essential for business expansion and working capital. The availability of funds that are gained by credit facilities to the company are essential for business expansion and working capital. Their disadvantages: interest burden, repayment obligation, non-fund based credit facilities. Financial support where no direct funds are transferred. Instead, banks provide guarantees or commitments on behalf of the customer. Example, bank guarantee. A construction company secures a bank guarantee from SBI to bid for a government infrastructure products. Letter of credit. A letter of credit is issued by a bank to foreign supplier that the payment will be delivered on the payment will be made on the effective delivery. Securities and modes of charges: mortgage, lien, pledge. These are the four types of securities and modes of charges: mortgage, lien, pledge, hypothecation. Securities: assets pledged by borrowers to secure a loan from financial institutions. Securities provide a security to lenders and enables borrower to access credit facilities at ease. Securities are used as collateral, which helps borrowers to get loans on lower interest rates. Charge. The word charge is used to mean any form of security or debt. Section 216 of the Companies Act 2013 provides the following: charges of a company are to be registered with the Register of Companies. Charges are of following types: a charge for security debentures, a charge on the uncalled capital of the company, a charge on immovable property, a charge on any book debts of the company, a charge not being a pledge or any movable property of the company, a floating charge on the undertaking or any property including stock in trade, a charge on a ship or share in a ship, a charge on goodwill, on a patent or a trademark or a license under copyright. After creating charges, a charge must be registered with the appropriate authority where applicable. Charges are registered with RTOs, CRSAI, ROC, etc. within the prescribed period. All mortgages and hypothecations shall be filed with the searcher within 30 days of their creation. The charges has to be created by the company should be filed with ROC within 30 days of its creation. Creation of charge by the borrowers on various kinds of securities or assets means the creation of a right in favor of the bank. By creation of a charge, the ownership is not transferred in favor of the creators. Fixed charge, also called as a fixed charge. It extends over a specific property of the company. The fixed charge gives right to the creditor to sell the property and claim the proceeds towards the dues payable by the company. It is created on properties such as land and building, plant and machinery, whose identity does not change during the period of loan. Floating charge. This charge is a general charge, not a specific charge. It is created on assets which will change, like stocks, mutual funds, etc. Floats over the present and future property of the company, and it do not attach any specific properties. On happening of an event or contingency, crystallizes as a fixed charge, a floating charge in an equitable charge, which does not attach on any specific property but covers the whole of the company's property. Mortgage. Mortgage is defined as transfer of property. A mortgage is the transfer of an interest in specific immovable property to secure the payment of money. These are by way of loan, an existing or future debt, or the performance of an engagement which may give rise to a pecuniary liability, financial obligation, or responsibility. In mortgages, the transferor is called as mortgager and the transferee is called as mortgagee. The principal money and interest of which payment is secured for the time being are called the mortgage money, and the instrument by which the transfer is effected is called the mortgage deed. Interest in the property and possession. The mortgagor only parts with the interest in the property and not the ownership. A mortgage is not merely a contract, but it is the conveyance of an interest in the mortgage property. As regards the possession, except for the unstructured mortgage, the possession remains with the mortgagor. Following are the features of a mortgage. Loan amount. Mortgages can be created to cover general balances, existing payments, as well as future loans or advances. Relationship. There must be a creditor and debtor relationship or a contract of guarantee between the bank and the mortgagor at the time of deposit of title deed. Future date. Actual existence of the date is not necessary. Even an application for date and its acceptance establishes this relationship. Effective date. A registered mortgage and equitable mortgage becomes effective from date of mortgage. Enhanced limits. To cover the enhanced bank limits, a supplementary registration deed is required because the mortgage already does not cover the enhanced amount. Repayment of loan. On repayment of debt, the mortgage does not remain valid. Uh, there are six types of mortgages defined by the Transfer of Property Act 1882. First is the simple mortgage, then mortgage by conditional sale, unsurfaced mortgage, English mortgage, equitable mortgage, or mortgage by deposit of titles deed, anomalous mortgage. Simple mortgage. There is a personal undertaking by the mortgagor to repay the loan. Possession and enjoyment remain with the mortgagor. There is a power of sale, but to be exercised only through court. So the mortgagor cannot sell the home or car that is been bought by taking loan without the power of without the permission of a court. It must be affected by a registered instrument. There is no delivery of ownership or possession. There is no foreclosure. Foreclosure means when a borrower fails to repay a loan, the lender can take full ownership of the property that was kept as security and sell it to recover the loan amount. Mortgage by conditional sale. It states that where the mortgagor ostensibly sells the mortgage property on condition that on default of payment of the mortgage money on a certain date, the sale shall become absolute, or on condition that on such payment being made, the sale shall become void. There is also a condition that on such payment being made, the buyer shall transfer the property to the seller. The transaction is called as mortgage by conditional sale. There is an ostensible sale by the mortgagor to the mortgagee of the mortgage property. There is a condition that the sale shall be void if the loan is repaid on a particular date. Then property is then transferred to the mortgagor. The remedy of the mortgagee is by a suit for foreclosure. Suit for foreclosure means if the borrower does not repay the loans within the agreed time, the lender can file legal case in court to permanently stop the borrower from reclaiming the mortgage property and take full ownership of it. This type of mortgage is suitable for the lender so as it is secured. Unstructured mortgage. It states that where the mortgagor delivers possession or expressly or by implication binds himself to deliver possession of the mortgage property to the mortgagee and authorizes him to retain such possession until payment of the mortgage money. There cannot be two different usufructuary mortgages on the same property at the same time, as the possession can only be given to one only. In this type of mortgage, the mortgage has the advantage to repay himself. The next type is English mortgage. It states that where the mortgagor binds himself to repay the mortgage money on a certain date and transfer the mortgage property absolutely to the mortgagee, but subject to a proviso that he will retransfer it to the mortgagor upon payment. The remedy for this type of mortgage is by sale and not by foreclosure. In this, the mortgagor ordinarily undertakes to repay the debt personally. Equitable mortgage. It states that where a person in any of the following towns, namely the towns of Calcutta, Madras, and Bombay, and in any other town which the state government concerned may, by notification in the official gazette, specify in this behalf, delivers toward creditor or his agent documents of title to immovable property. The object of the legislation is providing for this kind of mortgage is to give facility to the mercantile communities. The provisions which apply to a simple mortgage are also applicable to a mortgage by deposit of title deeds. In both mortgages, no delivery of possession of property takes place. Anomalous mortgage. It said that the mortgage, which is not a simple mortgage, a mortgage by conditional sale, an usury mortgage, an English mortgage, or a mortgage by deposit, deeds within the meaning of Section 58 of TPA is called an anomalous mortgage. The rights and liabilities of the parties to such mortgage are not determined by their contract. The mortgagee remedy is by sale and also foreclosure if the terms of the mortgage permit. This is a summarized chart of the type of mortgage, their ownership, reverse mortgage. Reverse mortgage involves the senior citizen borrowers mortgaging the house property to a lender, who then makes periodic payments to the borrowers during the latter's lifetime. Next is lien. A lien, a legal claim or right to someone else's property, can be placed on various assets to secure payment of a debt or obligation, including real estate, personal property, and financial assets. Lien is the right of one person to retain goods and securities in his possession. Also, lien does not give power to sell, but only to retain the property. A mortgage is a specific type of lien where the property owner pledges their property as collateral for a loan, while a lien is a broader term for any legal claim on property, including mortgages that allows the creditors to seize the property. Real estate mortgages. Lenders typically place types of these are the types of lien. First is real estate mortgage. Lenders typically places a lien on a property as collateral for a home. Property tax, mechanics liens, judgment liens. Second is personal property, vehicles. Lenders can secure loans with vehicles by playing a lien on the title. Equipment, similar to vehicles, liens can be placed on machinery or other equipment. Then there are household goods, jewelry, and other valuables, which we can place our liens and get loans. Financial assets. We can also place liens on financial assets like bank accounts, stocks and investments, and lawsuits. Particular lien. Section 170 of the Indian Contract Act 1872 defined particular lien as where the bailee has, in accordance with the purpose of the bailment, rendered any service involving the exercise of labor or skill in respect of the goods bailed. He has, in the absence of contract to the contrary, a right to retain such goods until he receives due remuneration for the services he has rendered in respect of them. So basically, a particular lien means a bailee, that is a lender with the purpose of the of lending rendered any service involving the exercise of labor or skill in respect. So goods are bailed. He is he is able to get his money back. A particular lien is that lien which confirms the right to retain that particular commodity in respect of which the particular debt arose. General lien. In accordance to the section 171 of the Indian Contract Act 1872, general lien is bankers may, in the absence of a contract to the contrary, retain as a security for a general balance of the account any goods billed to them, but no other person has a right to return as a security for which balance goods billed to them, unless is an express contract to that effect. A general rule confers a right to retain goods and securities not only in respect of a particular debt incurred in connection with them, but in respect of the general balance due by the owners of the goods and securities to them. Bankers' lien. As a general rule, the right of lien does not give the person exercising the right any power or right to sell or dispose of the securities retained. But in case of a bank, it is otherwise. A banker's lien is more than a general lien. It is an implied pledge, and the banker has a right to sell the property after reasonable notice, provided the property comes into his hands in the ordinary course of his business. Negative lien. At the time the advance is made, the banker sometimes asks a borrower to execute a letter declaring that his assets are free from any sort of charge or encumbrance. The borrower also undertakes that the assets stated in the said declaration shall not be encumbered or disposed of without a bank's permission in writing, so as long as the advance continues. This undertaking is known as negative lien. Set off. Set off is the right of a debtor to take into account a debt owed to him by a creditor when claiming a debt due from him to the creditor. In the case of a banker, the right of set off enables him to adjust a debit balance in a customer's account with any balance outstanding to his credit in the books of the bank. Pledge. According to the Indian Contracts Act, pledge is a bailment of goods as security for payment of a debt, performance of a promise. The bailer in this case is called the pawner or pledger. The bailee is called as pawnee or pledgee. The pledgee can sell the goods pledged after giving notice to the pledger. While in bailment, the goods can be retained or the bailer can be sued for charges. Bailment equal to delivery. So who can pledge? The owner of goods, the agent of the owner, the joint owner with the consent of other co-owner, and a person having limited interest in the goods. These, these are the persons who can pledge. Rights of pledgee. The pledges gets the rights of a bailee, which include right to retain, right to as to extraordinary expenses incurred, right where pawner makes
मुझे तो कुछ
default.
ये नहीं है कोई टेंशन
Duties of the pledgee are as follows: to return the goods along with assertion of goods, if any, once the money to paid back by the pledger, to take that much care of the goods which he would have been taking had the goods belonged to him. Hypothecation. Hypothecation is defined in the securitization and reconstruction of financial assets and informants of security interest, Act 2002. As per Section 2 of SARFAESI Act 2002, hypothecation means a charge in or upon movable property, existing or future, credited by a borrower in a favor of a secured creditor, without delivery of possession of the movable property to such creditor. Hypothecation is an equitable charge where the borrower is owner and keeps the possession of the security on behalf of the creditor. In hypothecation on the property, the ownership as well as possession of the security remains with the borrower. It applies to all movable properties like stock, crops, vehicles, machinery, furniture, etc. Hypothecation is resorted to in the following cases. When a loan is to be raised against a work in progress, the only way of crediting a charge is hypothecation. It is also done concerning goods that require constant handling in a factory. Example, rice mills, oil expellers, etc. This charge is also convenient where lending is to be done against goods in a shop or showroom which is required in day-to-day use. It is easily applicable to vehicles for private or commercial use. Drawbacks of hypothecation. The main drawback of this charge is that goods remain in the possession of the borrower and therefore creditors' control over such goods is not practically possible. The borrower may realize and sell the hypothecated stocks and keep only obsolete and slow moving stock. The borrower may hypothecate the same stock for more than one creditor or banker. The realization of the assets in case of default of payment is difficult, prolonged, and costly affair. Precautions to be taken in case of hypothecation. So banks ensure that the firm is not enjoying similar facilities with other banks on the security of bank same goods. Borrower enjoys facilities from one bank only and an undertaking in the writing should be obtained from him. A bank name board should be displayed where the securities are located stating that the bank has charge over such goods. If the borrower fails to return the advance against the hypothecation of securities, the bank can take possession of the securities with consent of the borrower and becomes a pledgee. On becoming a pledgee, the bank get all the rights of a pledge, including right to sale without intervention of the court. NPA. NPAs are non-performing assets. These are loans or advances where the borrower fails to make interest or principal payments for a specified period. The period is generally of 6 to 12 months. Managing NPAs is crucial for banks to maintain financial stability and liquidity. According to RBI, according to RBI's prudential norms, a loan is classified as an NPA if classification of NPA based on overdue period. So the overdue period is more than 90 days but less than 12 months, then it is a substandard asset. Description. Loan remains overdue for more than 90 days. A doubtful asset is a loan that is uh, a loan remains NPA for more than 12 months, then it is a doubtful asset. The if any asset which have defaulted for more than 12 months, then the asset is considered as non-recoverable and must be written off. Second term, special mention accounts classification. To detect stress early, RBI introduced special mention accounts before an asset becomes an non-performing asset. So there are three categories of special mention accounts: the SMA 0, the SMA 1, and SMA 2. Their overdue period is for SMA 0, the overdue period is 1 to 30 days overdue, and it indicates that delay in payment but still performing. In SMA 1, there is overdue period of 31 to 60 days. It indicates warning sign of potential default, and SMA 2 have a overdue period of 61 to 90 days, which indicates that high risk category approaching non-performing asset. To prevent and control NPAs, bank must adopt strong monitoring mechanisms. Uh, there are few types of monitoring mechanisms. First is early warning signals for NPA monitoring. These are delayed EMI payments, declining business revenues of the borrower, then frequent restructuring of loans, negative news about the borrower's financial health, and legal disputes involving the borrower. Second signs are regular audits or loan review mechanisms. Credit monitoring committees regularly review loan portfolios, automated NPA tracking systems, on-site inspections, and stock audits. Third is restructuring resolution plans. Corporate debt restructuring helps companies in temporary distress. One-time settlement allows borrowers to settle for a lesser amount. Recovery of an non-performing asset. The major acts governing NPA recovery in India are SARFA ESI Act 2002, that is Securitization and Reconstruction of Financial Assets and Enforcement of Security Interest Act. This act is applicable for secured loans of 1 lakh and above. It allows banks to seize and auction properties without court intervention. Process under surface. The process includes issue a 60-day demand notice to the borrower. If unpaid, banks can take possession of assets and sell them. Recovery through asset reconstruction companies. Second is insolvency and bankruptcy code. Applies to corporate defaulters. Enable faster resolution of stressed assets. Appoints resolution professions to take over management. If resolution fails, the company goes into liquidation. Then third is debt recovery tribunals under Recovery of Debts and Bankruptcy Act. Bankruptcy Act. It is applicable for loans above 20 lakh. Faster alternative to civil courts. If borrower does not repay, the tribunal can attach properties and recover debts. Lok Adalat. Used for small value loans up to 20 lakh. Settlements happen through negotiation, avoiding lengthy court cases. One-time settlement scheme. Banks allow borrowers to settle at a discounted amount to recover part of the loan, typically used for small and medium enterprises. Role of digital platforms in expanding credit access. Wilder risk. Digital platforms help extend credit to underserved and remote populations, including those without traditional credit histories. Faster processing. Automation and AI enable quick loan approvals and disbursal, reducing time and paperwork. Alternative credit assessment. Use of non-traditional data like mobile usage, transaction history, etc. allows lending to new to credit individuals. Lower operational cost, financial inclusion, real-time decision making. These are digital lending platforms in expanding credit access. So the summary of Indian banking system. Banking structure in India includes 12 PCBs, 21 private banks, 44 types, commercial, investment, central, cooperative, development bank. Functions banks accepting deposits, providing credit, enabling payments, managing wealth and currency. So we learned about credit facilities and securities. Credit facilities are secured, unsecured, fund-based, non-fund based. Securities are securities and charges, NPA, recovery mechanisms.